You're watching us here on Midcap Radar. Good afternoon. There has been a sharp slide from the highs for the frontline indices. The Nifty down almost 0.75%. I'm Manglam Malu. With me, Vivek. We'll talk about the markets in just a bit, but let's go to earnings. Pidilite reported a good operational performance. Gross margins increasing sharper than expected. I spoke with the company's MD CEO Bharat Puri to discuss their first quarter performance. Began by asking him about how they managed to grow volumes in double digit despite the disruptions in the quarter, but more importantly, what the outlook is. Hear it out.
You know that at Pidilite, we have been on a journey where we see each quarter as a continuing journey. We have a very clear strategy in place, core categories to grow at 1 to 2 times GDP, growth categories at 2 to 4 times GDP, enter new pioneer categories which become growth categories. We've continued on the journey. It's not that we've also seen disruptions in the first quarter. For example, the long election and its related impact on whether it was wholesale, whether it was on availability of labor. This, along with the severe heat wave in large parts of India, did impact us. But we've obviously continued on the journey we've been on. So, for example, one of the things that has worked for us and continues to work for us is rural growths are still 1.5 times urban growths. This is something that we've now been seeing for the last 8 quarters. Our investments in emerging India, as we call it, whether it is rural or small town India, our Pidilite Ki Dunia initiative, we now have 14,000 Pidilite Ki Dunias in villages below 15,000. We've now got 28,000 villages under direct coverage with a population of below 10,000. So we're, whether it is sales and distribution, whether it is innovation, each of our divisions has launched a range of products. At Fevicol, we've launched Nail Free Ultra, which is a substitute for nails in your home if you want to put up towel racks or mirrors. At Dr. Fixit, we've launched a product called All Seal, which helps your home, actually seal against waterproofing under construction. Fevikwik has a new range. So we've got a whole range of innovations. We've got the supply chain in place. And therefore, the Fevicol elephant has kept marching on. We'd hope now the current good monsoon actually also improves in distribution. And the festive season is great. And we don't have any new geopolitical events. Then we are really optimistic about the second quarter and more importantly, the second half.
You preempted my next question because, while you aspired to grow at double digits in your consumer business, this time around was just about there, close to around 8%. So with the disruptions out of the way, I believe that would be on the cards. What about the B2B business? That grew 18%. That's a pace that we haven't seen earlier. Was there something different this time around, and is that sustainable?
See, we've been calling out for some period of time that we are recasting our B2B business. We are clear that we want to move up the value chain, go into newer value-added businesses. So actually, one, obviously that has happened. The second is very simply the international environment, especially for our pigments division, which suffered last year, this year has really come back very, very strongly. So overall, again, we will look at double-digit volume growths, not just for consumer and bazaar, but also B2B going forward.
All right. And what about the margins? I mean, we have seen a bigger decline in VAM prices from the fourth quarter now into the first quarter as well. And that's reflected in the way your gross margins and EBITDA margins have panned out. And now as we speak, closer to 24%, they're at the higher end of your band. Do we expect it to moderate from here on, maybe some more price cuts in the offing for you to pump up volumes a lot more? I mean, or do we also see them going above that band that you've given, 20 to 24%?
See, as far as we believe now VAM prices have reached where they're not unlikely to go down any further. We're in a comfortable position as far as VAM is concerned. Whatever price cuts we had to take, we have taken, which is why you will see that our value still lags volume. I think in the second half, you will see value and volume both converge. And again, barring any geopolitical events which, completely change the environment, I think both from a sales and profitability point of view, we remain fairly optimistic about the rest of the year.
You often give us, the 20 to 24% band on a consolidated basis. Let me just ask you on both the businesses. Do you have any specific bands that you target either in the industrial business or the consumer business?
We have clear formulas as far as core segments are concerned. We have a certain investment both in ASP as well as manpower. We have separate investments in growth segments. Pioneer is something that we don't worry about from a financial point of view. From the first year, we obviously make sure that gross margins are adequate, but we invest. So we have clear algorithms in Pidilite. Now, I'd be disclosing a lot if I disclosed all of that to my competition, but you can see that most of it seems to work.
All right. On rural, you said it's growing at 1.5 times. What's your aspiration here? 2 times? Do you foresee that coming in the next couple of quarters?
See, if rural demand, and frankly, we will only know this, Mangalam, post-September, because as of now, the second quarter is always a light quarter. So the second quarter is, especially July and parts of August, are not representative of the festive season because of the very strong monsoon. So, this question, if rural demand does pick up, because there has been a strain in rural India, I definitely think that rural growth will improve. But I think this question is probably best answered in the end of the September quarter.
And what about the value-volume convergence? That happens in the second half. Do we see some bits of price increase towards, say, the end of this year?
See, what we are finding is, with the exception of VAM, there is a little bit of inflationary trend in other raw materials. It's not significant. We're looking at it. If we feel the need, it'll be minor at best. It's not going to be any major price increases.
How big has the tiles category become, and what are these new categories that you're entering?
See, as far as tiles is concerned, really what is very encouraging for us is we're growing at a very healthy pace. But even now, 1 out of every 4 customers in India actually uses tile adhesive. 3 out of 4 actually just use plain cement. So you can see the runway for growth is a long runway. And, again, our objective is not to worry just about competition, but to worry about growing the category. So as far as I can see, the next 3 years, tile adhesives will be a very strong growth category. Similarly, you will see us enter some other new growth categories.
Which is what I wanted to know once again. What are those new growth categories?
Like, for example, we've put up a plant, so that's not confidential anymore, for exterior renders. Now, this is a product that's never been made in India. If you go to parts of Europe, you will find on the exterior, they have this plaster cum paint, which, works for 8 to 10 years. We've just put up a new plant for that in Rajasthan. That's a new category for India. Now, that's a category we'll seed. It will take some time because it's completely new. But like this, that Pidilite is, as we say, long-term player. We spot unserved needs, we fill those with a product and then a brand, and then we work tirelessly until we create the category. So you will see that happening.
Plaster plus paint. Should your previous company worry?
I don't think anybody should worry, and they have enough to worry about with other competition. We're a small player who is very clear about small town and rural India. We're at our own pace. We've always said that, listen, we are not getting into the ring and, getting into this big bang approach. We're happy with where we are. Companies like us, with the strong sales and distribution reach that we have, the first 6 months, everything is successful. So I've always said that, listen, I will comment on the paint initiative after one full festive season and see where it settles down. But overall, as I said, I don't think any of the paint companies have much to worry about.
Well, a very interesting conversation there with Mangalam, with the management over there. Let's now slip into a short break. When we return, we'll be joined by the management of Godrej Consumer Products to discuss the quarter gone by and the outlook going forward. Welcome back to Midcap Radar. The market continues to remain quite choppy. The Nifty has given up significant gains, now down almost 140 points. But it's the broader end of the markets that are doing quite well. The Midcap Index continues to hold with minor gains of close to 0.4%. A couple of stocks that on our radar. First stock on the radar is Bharat Forge. The company came out with its results around an hour ago. The company also uploaded its presentations where the commentary that the company has given appears to be quite strong. They say that they continue to see profitable growth going forward, with commentary especially strong as far as the defense part of the business is concerned. What's actually tempered expectations is the overseas business, where exports have actually cooled off on a sequential basis. On the back of that, Bharat Forge and also Motherson Sumi too has seen a bit of a spike in the last hour of the trading session. But moving on, we'll now have to shift our focus to Godrej Consumer. The company reported its Q1 numbers and saw its net profit surge over 40% on a year-on-year basis, while revenue declined during the same period. To discuss this and more, we are now joined by Asif Malbari, the CFO of Godrej Consumer Products. Mr. Albari, welcome to the show. First up, tell us about the demand environment and the outlook for the entire year going forward.
We're quite happy with the way the quarter shaped up. In the beginning of the year, we had called out three key important deliverables for us. It was volume growth in India and Indonesia, and overall the shape of EBITDA growth. So when you look at the quarter which has gone by, we delivered an 8% organic underlying volume growth in India, 7% underlying volume growth in Indonesia, and an overall EBITDA growth of 13%. So all the right mixes went in. As we kind of are looking towards the end of the quarter and as the current quarter has begun, we are seeing some green shoots in terms of rural demand patterns, and hence we are quite hoping that we are able to kind of build on from the volume momentum which we've got. Another piece which is kind of spanning out is we are coming towards the end of the deflationary commodity scenario. Over the last few months, there has been mild inflation, which we're seeing across the board. And hence, going forward, we should actually see revenue growth being ahead of volume growth for us. So again, that should aid overall growth scenario.
All right, revenue growth ahead of volume growth. You've guided for 2 to 3% price growth along with, high single-digit volume growth this year itself. Let's talk about margins. This year, we did see some coming off in the margins in India, even as international margins saw marked improvement. So what's your margin band, Mr. Malbari, for this year?
I think, we've guided for this year, saying that our aspiration would be to ensure that we deliver high teens EBITDA growth. And broadly, we are in track on that. The India EBITDA margins have been off by only 20 bips. We still delivered a very, very healthy shape of 25% EBITDA margins for the India business. But if you see the growth in EBITDA margins in the international business, we've actually kind of improved margins across all the businesses, Indonesia, GOM, and in LATAM. And hence, it's a I would say, more broad-based shape of margin improvement, which we've been able to deliver. And the idea would be to sustain EBITDA margins between a 25 to 27% band, while improving margins in the overseas business.
Okay, could you quantify the market share gains across the categories that you saw in the last quarter?
Personal wash, we've been gaining share over the last couple of years, and the last quarter is no different. That allows us to kind of deliver low single-digit volume growth in personal wash, but given the high penetrations, that's a good shape to be in. In other categories, again, our market development actions have been working well. So we have been gaining share in the hair color category. We've been gaining share in hair care. So overall, in most of our categories, we've not only been gaining share, but we are also focusing on market development and increasing the penetration, because these are still very nascent categories. And hence, both levers have been working quite well for us.
All right. One of those nascent categories that you're developing now would be, the deodorant category and sexual wellness that you have from Raymond, which is now at a 150 crore quarterly run rate. Now, you've given us your aspiration. Just wanted to know whether you're on target there. What's the revenue and margin target here? Because you scaled down some of the GT, inventory there.
quite happy with the synergy benefits which have flown into the business, and hence the shape of the business in terms of margin profile. And we know that we've already kind of got the synergy benefits in the base, and hence the shape will be delivered as it is. We've done some actions in terms of portfolio simplifications, and hence taken off around 10 to 15% of the revenue to kind of get it into a sharper portfolio as we now build distribution and growth. And hence, when you look at it from an optics point of view, while the numbers look similar, it's actually coming on a base which has been reset 15-20% lower. And hence, that's the kind of growth which we've delivered. So we're happy after kind of getting in the portfolio, looking at how we want to build it in the future. We're quite happy in the way it's kind of shaping up. It's a little bit slower in terms of absolute revenue compared to what one would have liked it. But when you factor in this simplification, it's come to a good shape.
That gives us a good sense of how the Raymond portfolio is shaping up. But what's your outlook for the international business? Especially, have you completed all of Africa's restructuring, and what is the target for the next couple coming of years?
So we've taken in and we've completed the larger part of the simplification. There are a few actions which are planned as we go along, which will fall in place, but the larger actions have been completed. And what we're now trying to focus on is running an efficient operation. So the last quarter, we've actually focused on bringing down the trade inventory. While offtakes are kind of going in line with plan, we've significantly reduced the trade inventory. Given that the interest rates in some of these countries is as high as 25 to 30%, it's in everybody's interest to operate with lower level of trade stocks. So that's what we focused on. But in spite of bringing down the turnover in the medium term, we've actually reshaped the business shape to a really good level. I mean, we were operating the Africa business at single-digit margins. The last 2 quarters, we've been able to bring it to a 14% margin shape and grown absolute profits also. So last quarter, actually, we saw a significant improvement in the margin profile across all our 3 international clusters. So we're quite happy with the way the profit shape is coming through.
All right. The biggie was the announcement that came in from the pet care side. 5,000 crore market growing at around 15%. You're looking to enter this. There are synergies with Godrej Agrovet as well. So the question that begets asking is, just the way Tata Consumer at some point, took over the consumer business of Tata Chemicals, would there be at some point, any sort of arrangement that would come by with Godrej Agrovet as well? They have the animal feed business. You're entering pet care. I'm just throwing that out in the open.
No, so I think to just keep things simple, firstly, we are very, very excited with entry into pet care. We've been working on this for the last year and a half, and we believe it's still a very, very nascent category in India, but it's large. It's a 5,000 crore category, and opportunity over the next decade, it's quite large as it kind of grows at strong double digits over the next decade. As you said, we have a right to win as a group because Godrej Agrovet is India's largest animal feeds company. The structure is quite simple. We are going to be setting up a subsidiary company under GCPL, and hence all the risks and rewards are going to be in this company, which is going to be set under GCPL. And Agrovet is going to be the manufacturer and the R&D partner, and it is going to be an arm's length, co-packing contract with them. I mean, at this stage, the focus is on pet care and not onto the larger animal feeds business.
Could you give us a sense of the expected revenue and market share aspiration as far as the pet care business is concerned?
I think it's too premature for me to kind of call out an aspiration, but definitely in all categories which we enter, we look at being in one of the top players in the segment. So that definitely will be the aspiration. As we come more closer to the time of the launch with the mix, I think I'll kind of give a better guidance.
All right, a better guidance on pet care has been a very exciting category. Nestle entered it with Purina a couple of years ago. Then in the listed space itself, Mr. Malbari, we do have a couple of other companies as well, the likes of Cosmo First and even Rosary Bio. Thank you. Always a pleasure speaking with you. Wish you good luck for the remainder of this year. Before we slip into a short break, one word on the market. The Nifty is pared some of its losses. The Nifty banks, the one which is leading from the front, has now moved back into the green. But most importantly, we have a big surge that we're seeing on MRF. Reported its numbers just about 15-20 minutes ago, a 17% revenue growth, the EBITDA growing by about 2% a lot better than what some of the other peers have reported, and as a result of which the big boy has moved big. Also, today's up move on the stock is nearly 7,600 rupees, taking the stock above that 1,42,000 mark. Take a short break, come back, get you more of the markets and a lot of individual stocks.
Welcome back to Mid-Cap Radar. Well, one particular stock that's seeing quite a bit of selling pressure today is Apollo Hospitals. Remember yesterday, we had highlighted about a Macquarie report that had indicated about how Bangladesh, have actually seen quite a bit of medical tourists that come in to the Indian hospital space. They said that this could be a risk as almost 7 to 9% of the total revenues actually do come in from foreign tourists. On the back of that, we did see a certain amount of trepidation that Macquarie had highlighted on this particular development. Today, we're seeing quite a bit of a sell-off on Apollo Hospitals, down over 2.5% today. But that's all the time that we have on this edition of Mid-Cap Radar. Mutual Fund Corner when we return.